All right, everybody, welcome back to Alternative Finance. My name is Alex, and today we are talking about diversification. We are moving along our Investing 101 series. So if you are here for that, thank you for joining us. And if you like this type of content, smash that like button, give us this channel a subscribe, send it to your friends so we can get that message out there. And without further ado, diversification. Here we go. So first and foremost, what is diversification? It is an investment strategy that involves spreading your money across a variety of assets to reduce your risk. So the idea here is simple, and I'm sure you've heard this saying, you guys, not putting all of your eggs in one basket. By doing that, you're less likely to suffer significant losses if something bad should happen to any one of your particular investments. Right? It's not rocket science, we get that. Let's dig into it a little bit more. So what are the different types of diversification? That's right, you guys. There are different types of diversification. Let's talk about it. First and foremost, you have diversification across asset classes. So this is probably, from a general standpoint, what most people think of when they think diversification. So this is taking your assets and splitting them between things like stocks, bonds, real estate, cash, and giving yourself exposure to different asset classes. For example, if you've heard of the 60-40 portfolio, that's a term that gets thrown out a whole lot. That is referring to having a portfolio that is 60% equities, so things like stocks, and 40% not equities, so fixed income, things like that. That would be what you think of when you hear like a 60-40 split, and that is a diversification across asset classes. Next up, we got diversification within asset classes. So now we're looking within that 60% equity in the portfolio we just mentioned. We want to be splitting that up between things like different industries, different countries, small companies, big companies, all those different kinds of areas. We want to make sure we have a healthy diversification of all of those, right? That way, if something happens to a certain sector, or if we enter an environment that's harder on smaller companies, we have exposure to different things and we're not getting hit too heavily in any one area. Likewise, if you're talking about bonds, you want to make sure you have a different variety of types of bonds in there between treasury bonds, municipal bonds, corporate bonds, bonds that mature in 5 years, in 10 years, in 15 years, having different diversification across asset classes, but furthermore, within those asset classes. That is what we're talking about here. And this is a good time in the video, a good point to stop and reference our video from yesterday. Yesterday, we talked about funds. So things like mutual funds, exchange traded funds or ETFs, and those types of funds can provide some, at least some, of that diversification for you. And I say some because ETFs, mutual funds, generally do a great job of diversifying within asset classes. So if I buy an equity fund or a large cap fund, it will own a bunch of different companies that are large cap companies and provide me that within asset class diversification. I am still responsible for making sure that I have that across asset class diversification. So making sure that I am getting enough fixed income exposure, and furthermore, making sure you're diversifying large cap to international to small cap and getting all those different types of exposure when you use funds. So funds can provide some diversification, but they will not do it completely for you. There is still some responsibility on your plate where you will need to make sure you're fully diversified and your portfolio is good to go. Now, before we wrap up, I do want to quickly touch on the concept of over diversifying, because yes, over diversifying is a thing. So let's talk about what that might look like. So while spreading investments across different assets can reduce risk, excessive diversification may lead to unintended downsides and can dilute the benefits of diversifying in the first place. So what am I talking about? First and foremost, limited returns potentially. If your portfolio contains too many investments, the individual gains from high-performing assets are not going to be really fully felt. They may be diluted by the overall mix of your investments, and that would reduce your potential return. So you might have some fantastic investments in your portfolio, but your exposure to them is so small that you're not really going to be able to benefit when they do well. So we want to make sure we avoid things like that. Secondly, complexity. So having tons of different investments that are layers upon layers and all these different things going on in your portfolio can really increase the complexity of the portfolio and make it difficult to track what's going on within your investments and really be aware of when I need to sell something, when I need to buy something. There's just so much going on that it really makes it difficult to keep track of. In addition, it very well could lead to higher costs to have a whole bunch of different diversification layers inside of your portfolio. A lot of times these mutual funds are going to have fees associated with them, and when you operate within one mutual fund company, a lot of times they will offer you something which is called break points sometimes even. And essentially what that means is they provide you a discount for the amount of business you do with that particular firm. So using a bunch of different firms can hike up costs, and a lot of times, again, just those costs, one to the other, to the other, to the other, can really stack up and potentially create a higher cost scenario for your investment portfolio. Finally, redundancy. So when you tend to over diversify and buy a whole bunch of different things, what ends up happening is you have a lot of similar types of investments that are really trying to do the same thing as each other, and you end up doubling up on a lot of stuff, or having a redundant portfolio where you have a lot of things that are overlapping with one another, and it may even lead in some extreme cases to unintentionally being overexposed to certain areas of the market. We think we're diversified because we own a bunch of different things, but they may very well potentially be very similar in how they're composed. So when something happens, we are not really fully seeing the benefit that we were expecting from diversification. So before we wrap it up, I want to take one moment to say that the key to this is to strike a balance. Diversifying enough to reduce unsystematic risk, but not so much that your portfolio becomes inefficient. So diversify the things that we can, reduce the risks that we can control, but not take it too far and make our portfolio become inefficient. That is not what we want. This is where understanding risk management and portfolio strategy, which you're already exploring, becomes crucial. So you guys are here. You are learning about this stuff. This is how you make these decisions the right way. And as always, if you are looking for personal advice for yourself, consult a financial professional. And if you like this type of content, please smash that like button. Subscribe to the channel. We love having you here. Leave a comment. We love comments. And until next time, you guys, thank you for being here. And that is Finance AF.